Welcome everybody. Welcome to this webinar, How to Become a Homeowner 5 Times Faster Using the 3 Financial Strategies of the Wealthy People. I'm very confident you'll find some valuable lessons that we're going to share today. I'm going to introduce you to Ali, and Ali is my co-founder with Wealth HQ, and his mission, what got me when I sat down with this guy was his passion, his passion to try and educate these first home buyers and just help them have a smoother, happier journey. And that's what it's all about. That's what Wealth HQ is all about. So I'm going to jump in. Savers are losers in today's economy. So what do wealthy people do instead? We just talked about the income allocation and saving as much as you can so that you can have your deposit for first home. But there's actually a massive difference between savings and investing. Okay, savings is basically putting your money in a jar, and you already heard the news, like inflation are historically high. You're basically just might as well put it under your mattress. Is the same thing like if you put it in the bank, right? Versus where you're investing, you're growing your money. You're actually getting ahead. So that is the biggest difference between savings and investing. And I'm going to tell you a little bit more about this so that you can actually get a really good grasp on this. Because inflation right now is quite high, and savings rate in the bank, if you put it for a term deposit, it's 1.75%, okay? Inflation rate is already at 5.9, and it's going to be forecasted to be higher. What that basically means is if you've got money in your savings account, you're never going to get ahead because the money is actually devaluing so fast that you'll never get ahead.
So, Blandon, I just have to say with my clients, I used to say, hey, the money is sitting in your bank account, watching you working hard and laughing at you. That before inflation. Now the money is the villain, is actually working, but against you and laughing at you.
That's too good. You guys remember that metaphor, okay? So if you guys want to get ahead, you have to put your money in assets that are above the 5.9%, which are properties. At the moment, cryptocurrency is a huge one because, when we lose confidence in the monetary system, the cryptocurrency goes up. And also we've got funds and shares. Obviously, they all are risk. They have their own risk and they can be volatile. But on a longer term, you'll see that those assets will beat inflation. And so which one would you prioritize? Well, you've guessed it because we're on a first home buyer webinar. It's properties, right? So why do we prioritize property? Is one reason, and that is because of leverage. And what leverage is basically borrowing money to invest. Borrowing the money to invest. Okay, so you're actually taking someone else's money to put it in an asset that gives you return. Okay, so I'm gonna give you an example, like the maths behind it so you can see for yourself, slowly line by line. Okay, so let's just pretend you've gone up to a position where you've got $120,000 of deposits. Okay, what you're gonna be able to do at the moment, because the bank has loosened up a little bit, some people can get 90%, but it's more likely that you can get 85%. So maybe you can get $680K loan, and what that's going to allow you to do is do a purchase price of around $800,000. So if you bought a place, right, and you had it for 10 years, the average on the market return on properties has been around the 7% mark, okay? But just for argument's sake here, I'm going to show you something more conservative. Let's say you bought this for a property for $800,000 and it just grew at 5% a year. Okay, in 10 years' time, this property is actually worth 1.241 million, right? This is not you having to do more work. It's just literally inflation, right? Inflation, the property goes up and is at 1.24 million. Okay, so what does that mean? The first year in capital gains is actually 40,000. Okay, you're like, wow, Blandon, that's cool, 800,000 and I only get 40,000. That's very exciting. But what you need to look at when it comes to investing is you want to measure your return on the money that you have put in. The return on investment, $40,000 in capital gains on your $120,000 in deposits is 33% return on your money. Who's getting 33% return on their money at the moment? But for a normal person, 33% is very high. So that's why property and leverage is a very good first asset to prioritize. So I want to also show you, just zoom out, right? We want to go on a high level and just show you what is exactly happening on a overall with central banks and how they erode debts. And I'm going to explain to you what this actually means. Okay, so you guys have heard about this, QE, like quantitative easing. It means it's money printing. It means is injecting more money in the economy. Like, let's say the economy has $1 trillion. You're basically going to go and print another, 500 billion, right? So what the basically central bank is doing is going, okay, we're going to go print some money. And the next thing that happens is they go buy financial assets. I'm oversimplifying this. If you guys are in finance, you guys might want to, don't put me on the cross. But they buy financial assets. And what happens? Well, after they print money, what happens? If there's more money in the market, they're buying more assets, it's going to inflate the prices, right? Like on paper, you go on QV, you go on Homes.co.nz, you're going to see that your property price is going up like every single day. And that's what's happening in the economy. So after they do this, okay, they might buy some productive assets like businesses, but you know what government tends to do after they borrow this money? You might think, yeah, okay, maybe after they make more money, they'll repay this, right? But this is not the trend in the last 30 years, okay? What happens is that after the asset values have gone up, they go back to refinance, right? They got asset prices to go up. They can now borrow more debt from the bank. And it's a cycle where they print more money and buy more assets. Asset prices go up, inflated, and then they refinance to, run the economy on debt. And that is the monetary system, unfortunately. And this is on a high level, right? If the government on a high level is doing this, like what hope does it leave for us as an individual retail customer? Okay, so you got to look at the bigger picture, right? Look, you look at the US debt level. It has risen in the last 25 years, and it's kind of, you can just see for yourself. And you can see on the right side is the New Zealand net debt is slightly different from the first graph. This is total debt. This is net debt, so minus all our assets on our balance sheets. But what basically you can see here on the dip is 2008. That was the financial crisis. That was when our monetary system had a massive shock, right? What happened in 2008, our New Zealand system was, still more self-reliant. But as soon as 2008 happened, we became a price taker for a lot of our own debts in New Zealand. It means that whatever is happening in America or all over the world, we are price taker. We have to join in the party. Like if the prices of interest rate go up, then we're going to suffer as well. So just to give you an example, OCR went up. It doesn't really influence the bank rate by that much because only a small portion of our funding actually come from our own reserve bank. So you can see when the world prints money now, like we're sort of on the same trend, right? We started paying off a little bit of a debt in 2017 and 18, but you can see in 2020 and 2021, because of COVID, we started increasing our debt levels. And this is the consumer price index. This is like the price of your milk, right? Like, let's say if the price of milk 25 years ago was, say 70 cents, it was around 70 cents. Like, let's say it was in 1999. Today, for the same bottle of milk is costing you $1.10. That is the inflation that we're talking about. And this is higher than what you can save in the bank right now. So in summary, right, debt in effect becomes a asset in our today economy where it's heavily reliant on debt. Cash in effect becomes a liability. The more cash you have sitting in a bank is probably not doing you very well. Okay, and properties in effect becomes a hedge. And if you guys don't know what that term means, hedge just means you hedge your bet. So like, let's say if someone is if you're scared of losing money, if you hedge, you might pay a bit of insurance, then you're not going to lose as much. That's what a hedge is. So the big secret is, if I summed it up to just one line, is that if you want to get ahead financially, is actually get yourself ready into a position where you get into debt. No, not the car debt, not to get a holiday, not to do renovations. That's not the debt we're talking about. We're talking about investing in an asset that has a higher return than the cost of the debt that you're borrowing. And that's a very important takeaway that I hope you can remember, is that the monetary system, this is how it works. And if you don't get in a position where you're utilizing leverage to grow your assets, you're going to fall behind. Okay, so the example again is that if you have 120,000, you can get 33% by investing in a property that's got 5% return. Now, making this kind of decision by yourself can be daunting. And if you just need a bit of guidance, you want to understand the different implications if you make those decisions, do not hesitate to reach out to us at support@mhq.co.nz. Someone will be in touch. Alternatively, you can find our calendar on mhq.co.nz. You can just book a call. Someone will just get in touch and talk to you and guide you through and perhaps find you the right advisor that's going to be able to advise you. And until next time, I'll see you guys again.